Tariffs and trade wars can shake the market like a dog shakes a chew toy. Uncertainty makes investors nervous. When governments start slapping tariffs on goods, businesses get worried. Their costs go up, and that can hurt profits. This fear can ripple through the market, causing stocks to drop. Remember the trade war with China? The market hated it. Every time a new tariff was announced, the SPY would take a hit. It was a wild ride, let me tell you. Uncertainty is like kryptonite to the market, but here's the thing. Markets are resilient. They adapt. Over time, businesses find ways to adjust to tariffs. They might find new suppliers or pass on the cost to consumers. And when the uncertainty starts to fade, the market tends to bounce back. So, what's the takeaway? Tariffs and trade wars are like speed bumps in the market. They can slow things down, but they don't usually derail the whole ride. Keep your eyes on the long game and don't let the short-term bumps scare you off. Let's zoom out and look at the SPY on the monthly chart. This gives us a bird's-eye view of the long-term trend. We're looking for clues about the market's overall health. Each candle on this chart represents a month of trading. The body of the candle shows us the opening and closing prices for that month. The wicks, those little lines above and below the body, show us the high and low prices. Pay close attention to the color of the candles. Green candles mean the market closed higher for the month. Red candles mean it closed lower. See those clusters of green candles? That's a sign of bullish momentum. But don't get complacent. Those red candles remind us that pullbacks are a natural part of the market cycle. Those green candles on the SPY chart, they're like flashing neon signs screaming bull market. A green candle means buyers were in control during that month. They pushed the price higher, closing above the opening price. Now, a single green candle doesn't guarantee a bull market. But when you see a series of green candles, month after month, that's a powerful signal. It tells us the bulls are in charge, and the uptrend is strong. Look for long, strong green candles. These show strong buying pressure. Short, stubby green candles? They suggest some hesitation, but the bulls are still holding the line. Remember, candles are like footprints in the market. They tell us where the market has been and where it might be headed. Keep your eye on the 525 level on the SPY. This price level has been crucial in recent years. Think of it as a line in the sand between the bulls and the bears. When the SPY is above 525, the bulls are in control. This level acts as a support zone, a floor that prevents the price from falling further. But if the SPY breaks below 525, watch out. It could signal a shift in momentum, giving the bears the upper hand. Keep this level on your radar. It's a key indicator of the market's overall strength. Section 5. Echoes of the past. Market cycles and historical parallels. Remember the dot-com bubble? Investors were going crazy for anything tech-related. Valuations skyrocketed and the market seemed unstoppable. Then boom, the bubble burst. And the 2008 financial crisis? Another painful reminder that what goes up must come down. Now I'm not saying we're headed for another crash, but it's crucial to learn from history. Markets move in cycles. Periods of exuberance and growth are often followed by periods of correction and consolidation. Don't get caught up in the hype. Understand that pullbacks are a natural part of the market cycle. Use history as your guide to identify potential risks and opportunities. Section 6. Brace yourselves. Preparing for potential pullbacks. Pullbacks are a fact of life in the market. They can be scary, but they're also opportunities. Think of a pullback as a sale on your favorite stocks. When the market dips, don't panic. Use it as a chance to buy quality companies at a discount, but don't just buy blindly. Have a plan. Identify your target prices and stick to your strategy. Remember, pullbacks can be swift and sharp. They often catch investors off guard. Don't let fear dictate your decisions. Have a plan and be prepared to act. Section 7. The 20 SMA, your trusty sidekick in a volatile market. The 20-day simple moving average, or SMA, is your best friend in a volatile market. Think of it as your trusty sidekick, always there to guide you. This moving average smooths out the price action, making it easier to see the dominant trend. When the SPY is trading above its 20 SMA, it's a bullish sign. If it drops below, it could signal a change in momentum. Now the 20 SMA isn't perfect. It can give false signals, especially in choppy markets. But it's a valuable tool to have in your arsenal. Use it in conjunction with other indicators to confirm your trading decisions. Section 8. Mastering the market mayhem. Practical tips for investors. Navigating market volatility can feel like walking a tightrope. But don't worry, I've got your back. Here are some practical tips to help you stay ahead of the game. Do your homework. Understand what you're investing in. Don't just chase the latest hot stock tip. Control your emotions. Fear and greed are your worst enemies in the market. Have a plan and stick to it. Don't let emotions dictate your trading decisions. Diversify your portfolio. Don't put all your eggs in one basket. Use stop-loss orders. These help limit your losses if a trade goes against you. Remember, investing is a marathon, not a sprint. Stay disciplined, stay informed, and you'll come out ahead in the long run. Section 9, the bottom line, staying ahead of the curve. The market is a wild beast. Tariffs, political events, and global uncertainty can all send it on a roller coaster ride. But by understanding market cycles, analyzing candle patterns, and using tools like the 20 SMA, you can gain an edge. Remember, knowledge is power. Stay informed, stay disciplined, and never stop learning.